the most efficient tax strategy for seniors looking to retire early with multiple account types: locked-in retirement account, LIRA, RRSP, TFSA, non-registered, for both you and your wife. The goal is to have smooth, taxable income across retirement, avoid OAS clawback later, and maximize after-tax wealth. Here's a structured approach on board. Key priorities: tax efficiency over lifetime. Not just minimizing tax in the first few years. Income smoothing. Withdraw early enough from RRSP LIRA so required RRF LIF withdrawals in your 70s don't push you into high brackets. Preserve TFSA as the last resort account. Tax-free growth is too valuable. Income splitting. Use pension income splitting, RRIF LIF withdrawals after 65, spousal RRSPs, and equalize withdrawals between spouses. Government benefits: keep taxable income in check before 65 so OAS and GIS aren't clawed back. 2. Typical withdrawal order, general strategy. For high-income couples with your account mix, a common order is: 1. Non-registered accounts first. Spend dividends, interest, and realized gains first to reduce ongoing taxable investment income. Prioritize high-taxed income, interest before capital gains. This gives your registered accounts more years to compound tax-sheltered. 2. LIRA and RRSP withdrawals before 71. Between 57-71, start drawing strategically from LIRA RRSP, even if you don't need the cash. Purpose: smooth out taxable income and reduce large forced RRIF LIF withdrawals later. You can melt down RRSPs by withdrawing in years where you stay in a lower bracket, often targeting $50K, $100K to each spouse per year depending on tax thresholds. 3. TFSA last. Let it grow tax-free as long as possible. Use it later for tax-free top-ups, unexpected expenses, or estate planning, since it passes to spouse tax-free. 3. Refinements for your case: early retirement, 57-64. Likely no CPP OAS yet, so taxable income is under your control. Use non-RAG/SLUN, some RRSP LIRA withdrawals to create a steady income stream. Consider withdrawing enough to stay in the 20-30% marginal tax bracket each year, rather than 0%. If you have room, recontribute to TFSA annually with proceeds from withdrawals. Age 65 plus REF LIF income splitting. Up to 50% can be split with your wife, reducing tax. Pension credit: after 65, 2,000 RRIF by LIF income per person qualifies. Watch OAS clawback. Starts 90K net income per person in 2025. Try to stay below that. Coordinating with spouse. Since your wife has more RRSP but less non-REG, you'll want to draw down her RRSP somewhat earlier to balance taxable income in later years. Use more of your non-reg to equalize. At 65 plus, maximize splitting so you both stay in similar brackets. 4. Practical steps: map cash flow needs. Project yearly expenses and taxable income from now to age 95 plus. Run RRSP meltdown projections. Withdraw 60-80K combined annually, depending on your lifestyle and bracket room, from RRSP LIRA in your late 50s and 60s. Capital gains harvesting. If non-REG holds stocks, ETFs with gains, consider realizing some each year while in lower brackets. Defer CPP OAS to 70 if affordable, to get higher guaranteed income and reduce pressure on withdrawals later. 5. Example withdrawal order for you: approximate. Age 57-64. Non-REG first. Dividends are interest, then capital gains. Add in annual RRSP LIRA withdrawals up to target tax bracket, 80-100K combined income. Refill TFSAs each January with withdrawn funds. Age 65-71, continue RRSP LIRA withdrawals. Split. Ensure at least $2,000 RF LIF income per spouse for pension credit. Keep income under OAS clawback if possible. 71 plus RIF LIF mandatory withdrawals may be high. By then, you've already reduced balances to keep tax manageable. TFSA is your flexible buffer. The optimal plan really depends on your exact balances, lifestyle expenses, and provincial tax brackets. A proper retirement projection, cash flow plus tax modeling will give the best roadmap. Want more contents like this? Like, share, comment, and subscribe.